Hello, viewers. Hope your day is going well. Thanks for tuning in here. I hope you guys are able to find today's video useful. If you are, please give it a thumbs up or a comment to let me know that, this thing didn't totally suck. But, also if you did think it sucked, then please comment on that and I'll do my best to make it a better video the next time. So, either way, I appreciate any notes or comments. So today I want to talk to you guys about taxes since we're starting to hit the end of the year. It's going to be coming up soon where we have to file our taxes. Um, I thought I'd just kind of go over the general flow of how taxes with stocks and dividends all work in a general sense. So also have some examples set and some equations set in Excel. So I'll try to remember to click through a bunch of the cells so that it shows the equations in case you guys want to try and use those for your own stuff or just try to use it to understand in your own little test spreadsheets. Um, Hopefully I remember to do that as we go along. I apologize in advance for, the length of this video probably, as there is a decent amount of information to cover, and I do tend to ramble a little on, so I'll do my best to keep it short and concise and also simple so that, there's actually something you take away from this. So without any more talking, let's go ahead and dive in. Before I want to talk about the actual tax brackets up here, there are some overall notes about, stocks and dividends that I want to cover just before we get into all of it because I think it's good information to know if you don't yet. That's what I have right here. So the first one I want to cover is that only stocks that you have sold count towards taxes. So that means if you bought a tax and it hits the end of the year, so December 31st is passed by and you're still holding that tax or that stock, and then you sell it in January, that doesn't go on your taxes for this year, it goes on your taxes for next year. So just remember that anything that you're still holding, if you're up or down, whatever, and you haven't sold it yet, that does not get put on your taxes. So that's kind of like where the whole capital gain comes from is once you actually close that sale is when it actually becomes taxable. So if you have a stock for like 10 years that you haven't sold, then for those 10 years, you're not going to get taxed until you finally sell it. But I mean, I'm assuming if you held it for 10 years, it's got some dividends and stuff. Those are somewhat, isolated from the actual gain. So number two, stocks held longer than 1 year are considered long-term gains. So that means 1 calendar year, if you have a stock for a longer than 1 year time, from like January, or we'll say June 15th, all the way to, next year, June 15th, and then you sell it after that, it will be taxed at a lower rate than it would have been if you had held it for, say, 2 months and then sold it. So there are benefits to holding stocks for a longer term, and especially if you have some gains, like sometimes that discount bracket, that discount tax rate can really save you a lot of money, especially if you made a decent amount off of that sale. All right. Now, after gains, sometimes you don't always gain. Sometimes there are losses. Not everything's going to be a winner a lot of times in the stock market. So one thing to note is that if you do sell a stock to stop losses, you can have those losses deducted from your income this year, so that you have less income to be taxed as a whole. Now that also means that there's a rule that I believe they switched it from 90 to 30 days. So if you sell a stock and you want to deduct that loss from your normal income, then you cannot purchase that stock again within 30 days. So that way you don't just like sell your stock the day before the end of the year, then buy it back so that you can have a deduction for the taxes. That's kind of a loophole the government made sure to avoid. So if you do sell a stock and you haven't bought it back again, then you can deduct that from your income and get less taxed at the end of the year. And if you can do that, you get up to $3,000 if you're single. I don't know what the joint one is. I think it's like 6,000 if you file jointly, but you can deduct $3,000 worth of stock losses if you lost that much in any sale. Like say you had three stocks that all made gains, and then one stock that was a loss, you would just deduct that one loss. The other three would just go into your normal income. But if that one loss of stock sale is more than 3,000, or you have two of them that are each like 2,000 losses, I mean, we're going to hope that never happens, but you could deduct 2,000 this year, and the other loss could be $2,000 that you deduct next year. So it does carry over if you want it to, but typically $3,000 of losses is, I think, a pretty good amount. Hopefully you're doing well enough that you're not deducting that much. Moving on, oh, sorry, that was supposed to be number 4, 5, and 6. I guess I didn't renumber these. Uh, Anyways, dividend stocks held for 60 days are qualified, and 60 days before or after the ex-dividend date is what that means. So basically, this is a dividend version of your long-term tax gains. So if you hold a stock for over a year, then you get a long-term tax gain when you sell it. If you hold a stock for more than 60 days for a dividend, then it's also taxed at a lower rate. So both of those long-term holds give you lower tax rates. And this 60 days can be anything within a 121-day period. So 60 days before the ex-dividend date until the day of the ex-dividend, you could sell it, and that's how you qualify for the dividend. But if you held it for that 2-month period, then it gets discounted when you tax it. Or if you bought it the day before the ex-dividend and then you held it out for 2 months and then sold it, that would also work. So anywhere in that before-after time frame of like 121 days, if you held it for a 60-day period of that, then you will get a discounted tax rate. And we'll go through that later on in these other tabs about how those are, but this is just kind of the background on what these other brackets are that we're going to go through. The next item, not all dividends are cash. There are special cases of dividend payouts. So I did not know this when I had first started, so I hope this helps you guys to know you should look into what kind of dividend the company pays out before you end up, buying it for that dividend. A good example here is Blackstone Group. That's one that I had gone in on, but I did not realize that they did not pay a cash dividend. They are a special case where their dividend is actually made up of several different assets or items that I will most likely cover in another video, especially if you guys comment and say that you'd like that. That one is a little more complex, and by no means am I an accountant, by the way. Please just do your own research and double check me on all this. I just did all my research, and I work with an accountant on my taxes too. So I suggest that if you're a new time investor or new to taxes, definitely meet with an accountant maybe your first year or two and make sure that you take notes on what they tell you so that you can do it yourself later on and be absolutely certain that it's correct. But sometimes with special dividends, there's a little bit more complexity to it than it would be with just getting cash payments. So just try to make sure that when you pick a stock for a dividend, make sure you understand what that dividend payment is. And the last note is similar to the one we just went over. It's that there are special stocks. If you have foreign stocks, then they may have additional taxes, not just with dividends, but with also when you buy and sell the stock. So I put in this example from a Brazilian stock. So Brazil has a non-resident tax. So if you bought a stock, held it, sold it for a gain, you would have to pay taxes for the US gain, and you would also have to pay taxes for the Brazilian amount that they charge non-residents for, you're purchasing stock from their country. It's kind of like an international transaction fee. However, if you do have a foreign stock and you do pay those taxes, those can also be deducted from your tax, from your U.S. tax, so that you're not getting, overly taxed on one trade. So the U.S. government does help a little bit about foreign stock trades, but again, that's kind of a special one that if you're not familiar with it, just maybe go consult a accountant your first year or two, take notes, and then for the future. Because the first time you go through these, they are kind of difficult to grasp, and I am going to be working with an accountant this year to help me with these two, even though we've already been discussing it. So with that note, let's just go ahead and kind of dive into our tables. And I'll try to, just take this column by column here, and hopefully this turns out to be something you guys can follow. So this year, after the last, tax rate hikes and everything, this is the most up-to-date set of brackets that I know of. You can pull this from, pretty much just the IRS, type it into Google. But we have several brackets of what your income will be taxed at the end of the year. 10%, 12%, 22%, 24%, 32, 35, and 37. So the way that you are determined to have either one of these is based on your total income for the year. That's just how taxes work. I hope you understand that. So for 10%, this would be your income range 0 to 9.5 grand. If you make more than that, then you'd be taxed at 12%. And if you make more as you get through each one of these ranges, that will be your tax bracket range for 2018. So now, one thing about this is that this is a marginal tax system. So if you make $82,000, not, or sorry, $85,000, I'm saying to get us in this range. If you make $85,000, not all of that is taxed at 24%. So what happens is you'll be taxed all of this $9,525 at 10%. Then you'll be taxed this range of 9,526 to 38,700 at 12%. Then up till 82,000, you'll be taxed at 22%. And then the last couple thousand from 82,000 to 85,000, because that's your final income, will be taxed at 24%. So you'll only have about $2,500 taxed at 24%. The rest will be progressively taxed as your income breaks each bracket. So that's kind of a nice thing. It's not just a set in stone 24. It's you get taxed through here until you break through this bracket. Then you make your way through this bracket. If you're still above it, then you move up to the next bracket for the remainder. And that's kind of what's shown in here in this final tax formula is, 10% of income. That's your final formula because it's just 10% if you made less than $9,500. If you made somewhere in this range, then you make that 952.50, which would be the total that you could be taxed from here. That's what I put in this column is this is the max amount that you can be taxed within this bracket. And it just kind of progressively goes up to say in here, this 4,453.50 would be the total between brackets 1 and 2. So this is accumulating right here. So this would be the whole first bracket of 10% and the entire bracket of 12% would give $4,453.50. And then whatever your remainder is in this bracket here. So if you have like $50,000 total, you would have 4,453 and be taxed the rest of it in this bracket at 22%. So I hope that makes sense. If we got some examples now that we can go through. So the first one is $5,000. So if you make $5,000, then your income is in this first bracket and it will only be taxed at 10%. So your final amount being taxed is 10% of this amount. And again, I'm going to try to click through all of these cells that have formulas so that you can kind of copy it later if you want to try to test it out, make sure you understand it. But that's going to be this is the most basic one you can do. It's just a straight 10% income. Now it's where it kind of, marginalizes a little bit. So if you have $20,000 at the end of the year, that is taxable income. You're now in the 12% bracket over here. So your final amount of tax will be this $952 plus however much of your income is taxed at 12%. So you see in our formula we have 12% times your total amount of 20,000 minus the entry into the bracket, 95.25, because 95.25 was already taxed at 10%, so it doesn't get taxed again at 12. You only have what's remaining from your $20,000 to be taxed at 12. So now as we go up, we're at $50,000, which means we're in the 22% bracket in the midway but we will completely use up the 10 and 12%. So when you look at your total, you see D4 is the total from brackets 1 and 2 because you've made more than 38,700, so you used all of that 44,5350 gets taxed. And in addition to that, the leftover from your 50,000 gets taxed at 22%, which would be your total here minus 38,700 because that's the entry point into this tax bracket. And that's pretty much added in. You just keep going up, and each one of these will go up in that manner. So if you have 100,000, you're at 24%, which means you're at 14,089.50 plus the remainder of your 100,000 being taxed at 24%. And then it goes on the same for the next bracket at 32%. The remainder of it, once you break 157,000, gets taxed at 32. Other than that, it's also added to this 32,000. And if you're getting all the way up into this 35%, honestly, at these rates, you're probably not watching my video because you are probably smarter than me, already know more about stock investing. So I'm just going to buzz through these. It's pretty much the same idea. Take the max amount from the previous bracket and then add on however much of your remaining income gets taxed in this new bracket. So the last bracket, there's obviously an infinite amount that you could be, taxed because it just depends on your income. I mean, you could have made $100 million, or you could have made barely over the million, and you'd just still be stuck at 37%. So that's pretty much how your normal income works. That's like even before stocks or dividend, anything else. This is just normal income for the year. So even if you're not watching this because of stocks, you're just interested in how taxes work, this table is pretty much all you need. This will pretty much get you all the information you want on how much your final tax should be for the year. If this is like all you have is just straight normal income and nothing else. So just burn through those cells again real quick. So now let's go ahead and look at how capital gains can affect our, total for taxes this year. So now, like I said before, you have stocks that you sold after holding them for less than 1 year and stocks that you sold after holding them for more than 1 year. And they will be taxed at different rates. So let's start with stocks that are held less than 1 year because those are pretty common as far as swing trades, and it's a lot easier to calculate because those get taxed at the same rate as your normal income. So there's nothing special about them. You just add them into whatever your normal income is, and that's your total amount of income for the year. So you can see this table looks exactly the same as our other table because it works exactly the same as normal as this general income. Because that's all capital gains are, is if you held it for less than a year, then it's just general income. So say you made $3,000 in some other work and then you made $2,000 in the market, you still just get those $5,000 total taxed at 10%. And we use the same numbers here because it emphasizes that your income works exactly the same even though you have stocks. If none of them were dividends or anything, if it's just you bought a stock and you sold it a week later throughout the year and that's all you did, then this is going to be exactly the same. I didn't even put the equations in because they work exactly. I just copied it over from this. It will be the same exact set of equations. So I hope that makes sense. I feel like this one doesn't need to be covered as much since we just did it. Just know that if it's less than a year and there were no dividends, no long term, if it's just short, then it just gets added into your normal income amount at the end of the year. All right. I guess at this point, I should mention also that if you are making a decent amount in stocks, then like say you made $4,000 in stock trading in 1 quarter, then that's actually a decent amount of money that you made from stocks and income. So you should be reporting taxes quarterly because the government makes you pay a penalty for they call it like the government's like I'm not giving you a loan or something for the rest of the year. I'm not too familiar with that whole concept because I honestly don't make enough in the market yet to worry about it. But if you make more than like $3,000 a quarter based off of taxes, or sorry, not taxes, stocks that you've bought and sold, then you should file taxes quarterly because it will reduce the amount that you get taxed. It's something about like progressive income, and they don't pay a fee. They don't make you pay a fee for holding on to income for that long. I don't really fully understand why they care, but there's other videos. Please check them out. Read up on it if you do end up making that much money per quarter. So now I'm going to move on and go to discussing stocks that have been held for longer than a year and then you sold them because they have three different tax rates. The first one, which is the best, is 0%. The next is 15%, and finally 20%. So the way that these get determined is based off of your final income range. So this is similar to how these ones are, calculated. If your total between your regular income and your stocks, everything adds up to, less than 38,600, then the stocks that you held for more than a year when you sell them will have zero taxes on it. So that's pretty sweet because if you had like $37,000, um, but like 7,000, yeah, sorry, excuse me, 7,000 of them were made on a long-term sale. So you held the stock and made $7,000, and then you sold it after a year. Then that $7,000 is tax-free because it was still within this range. But then the next two are kind of a jump up this year. Uh, if you final income, this is the most common bracket, by the way, so you're most likely in this one if you held a stock for more than a year, is 15%, because that goes from if your total salary between your normal income and your stock sales is between $38,601 and $425,800, then your long-term stock sale will be taxed at a rate of 15%. And that's pretty much going to be the most common one, I think, for most people, at least for early investors and people like me that are have a day job and just do investing for saving up and trying to make a little extra money. And on the last range is if you make more than that 425,000 mark, then it's kind of similar to our 37% from the normal income range. You're kind of limitless on how much you can make, but it will all be taxed at 20%. So now let's go ahead and dive into some examples of how this will work out, and hopefully this will make a little more sense. So I wasn't even looking over here, but I had a pretty close example right there. Say your normal income from your day job is $30,000 in the year, and you made $5,000 from buying and selling a stock that you held for more than a year. So you held it from February of this year or last year and held it all the way until June of this year. That was more than a year, and then you decided to sell it for $5,000. Then your total income is $35,000, which means that you are still under that 38,600 mark. So all of these $5,000 dollars are taxed at 0%. But your normal $30,000 gets taxed as if it was a normal rate of $30,000 from your income. So same thing as this bracket, and same thing as if you had made $30,000 in this bracket. You just plug that 30K into, this cell at 12%, and that would be your total. Because the way it works is your regular income gets taxed before your capital gains gets taxed. So if we'll go through an example next, and it'll make a little more sense. Excuse me, a little more sense. So for this simple one, since you have 0% on that, it's just 30%, 12% on your 30K for this first example. So you would have all of that first 10% bracket fill out 952.5. All of that gets into your final tax amount, and then the remainder of your 30,000 for the next bracket. So 12% times your 30,000 minus the entry point of this 12% bracket. Now let's take a different example with the same worker who makes $30,000 and at his normal day job, but he did a lot better in the market the last couple years, and he sold his long-term gains for $10,000. So maybe he's been holding stock for 3 years and he finally decided to sell it for a $10,000 gain. That means that his total income for this year is $40,000, which means that he will be getting taxed. This income puts him into this 15% range. However, that doesn't mean that all of this gets taxed at 15%. That means that anything, it's similar to over here where it was marginally increasing. Your tax will get, you will get taxed at the normal range of, I'm sorry, not the normal range. You will get taxed at a progressive amount. So not all of that 10,000 will get, taxed off at 15% for this range. It's only until you break into the next bracket. So you can see this 30,000 becomes the first thing that's taxed. So this is normal income. That just gets put in like we did up here, where it's 30,000 times 12%. That was incorrect on my part. I apologize. This should be the same as that one because it's 30,000 at 12%. So let's just go ahead and copy that, put it over there. Oh. You know what? Yeah, we'll do this really quick. So we are, oh no, why can't I do my typing? I am so sorry for this, people. Let's go in here, put that in. Instead of using J3, it's the same amount, but we're just going to use our J6 amount and be good. So then they're the same. So you can see, since it's 30,000 at 12%, it's going to be exactly the same as this was here because that's our initial income. That's just normal income at our 12% bracket. So after that is done, then we go look at how much further up our capital gains take us. So after 30,000, we have 8,700 before we move into the next tax bracket. So that means, actually, I'm sorry, man, I am really off on this right now. So this would be the 8,600 is because that is our income range for the stock. So once you hit capital gain, oh wait, hold on. Oh, now I'm confusing myself here. All right, guys, I'm gonna go ahead and pause this really quick because I'm confusing myself. I don't want to waste your time. I'll be right back. Okay, folks, I'm back. Sorry about that. I guess I had a typo in here. It really threw me off, but looks like I had, the correct information in here for the rest of it. So let's go ahead and start over on this example. If we have $30,000 and 10,000 in long-term gains, then the 30,000 gets taxed at the normal 12%, like we said earlier. That's the same equation as we used to get that as if it was normal income, because it is normal income. And then after that, your capital gains get taxed at the capital gain rate over here because they're long term. So now for the remaining of 8,600, because we already used up the first 30,000 of our income at 0%. The remaining 8,600 here of our 10,000 is at 0%. So on this 8,600, none of that gets taxed. But then the remainder of our 10,000 gets taxed at the next bracket, 15%. So that'll be $210 in taxes between your gains alone. And if you sum up your normal income with those, this will be your final amount of tax. So you start with your normal income, and then you go to the long term, then you would go to short term gains, then you would go to long term gains. But your short term would pretty much just be assumed to be part of this 30,000, and your 10,000 then adds onto it later to build itself up into these higher brackets. All right, so now let's do another example in a different starting bracket at 50,000 of normal income, and you made 5,000 in a long-term sale this year. So your total is $55,000, but the first 50,000 of it are taxed as if they were normal income because it is at 22% bracket. So you would complete the 10% bracket, you would complete the 12% bracket, and then you would complete however much is left over in this 22% bracket to finish off that 50,000. Then the 5,000 would still be within this 15% bracket. So you are being taxed $5,000. All of your gains will be taxed at 15% instead of them being taxed at 22%. So that's where it really shows how much you're saving is because you have that longer one. If this was a short-term sale, that'd be $5,000 at 22%. And if you had like $77,000 or $80,000 salary and made 5,000, then you would even jump into the next tax bracket if this wasn't a long-term gain. If that was a short-term gain, that would be more likely to push you over into the next tax bracket too. But since you held it for longer, it's a smaller tax bracket range at 15%, and you're kind of less likely to break that bracket. So in reality, we can kind of compare how much it really saves you to hold on to a stock longer if you can. So we could say, compare the 22% of $5,000, which would be 1,100, versus the 0.15% or 15% of $5,000, and that's 750. So now we say, how much are we actually saving between those two? So holding it for a year saved you $350 in taxes. So if it's not a problem, you don't see like the stock going down the next year, it's probably worth holding on to for that extra year to have such a large saving in your taxes once you finally sell it. But if it's not that, if you think I see the stock going down, then maybe it's not worth holding on to for that year because you're losing the profit that you made on it. So you really have to try to think of this stuff ahead of time to decide whether or not you want to hold the stock for over a year, which you're probably already doing for the long term. If you have this stock for that long to make it even worth holding a year, you probably already considered that. But this is kind of the more common scenario I think that you would see with your stock is you have your general income and whatever short-term gains you have to make $50,000-$60,000 maybe between the two, or somewhere anywhere to keep it in within this range here, and your remainder long-term gains would probably fall under the 15%. I think that's the most common scenario that you'll see. And let's do some higher class ones again. If you're making these brackets, you're probably not watching my video because you're already doing pretty well and you understand stuff, but we'll go through this anyways. So if you have a base salary, or your combined salary of your normal job and any other income and your short-term sales, $400,000. So you're in this 35% bracket for all of that, which, is the same thing. It's just calculating it in this table and then doing the remainder of, like, the last 200,000 of it gets taxed at 35%. And then your last 50,000 of capital gains, you are filling out what's left in here because this is a long term. So you would have 400,000 plus 25,800 to close out this bracket will be taxed at 15%. Then your remaining 50,000, or your remainder of the 50,000, would be 24,200 at the final bracket of 20%. So then you would really just sum all of these up. So the remainder times 20%, your initial capital gain at the 15% bracket because you're within that range at that point, and then your normal, just 400,000 bracket income from just general income as if you were calculating it on this table, and that would give you a total of just about $125,000 in taxes. And the last one would be if you're just kind of breaking that last wall and you have that unlimited area. So you're getting pretty much everything in your normal income gets taxed at 37, and anything that you would gain is taxed at 20% because there's nothing higher than that. You're just already starting out doing the highest amounts. So, but remember, this 37 doesn't mean all 550,000 are taxed at 37. It means that you progressed through each one of these. So your final would be 150,000 plus 50,000 taxed at 37%, and then your 50,000 taxed at 20% from your stock trade. All right. So I hope that made sense. Last thing we'll talk about is dividend gains, which are pretty much the same thing as the capital gains. The only difference is that it is held for 60 days to become taxed at a lower rate. So if you held it for less than 60 days and you got a dividend, you held it for a week after you bought it, you qualified for the dividend, you did a quick swing trade on it maybe, and you got out, then it's just similar to a short term or just normal income. It just gets added in and taxed at your normal tax rates based on what your final income on the year is between dividend, stock, short term, and your normal income. It's just a general source of income. If it's held for that 60-day period within the ex-dividend date time, then it becomes qualified, and it's as if it was a long-term stock gain, capital gain, and it can be taxed in the same manner of these income ranges at 0, 15, and 20%. So we'll do another pretty much quick example. I believe I use like the exact same numbers in here. Again, just copy paste it because it works exactly the same. So you would have $30,000 in your normal job, and you found an incredibly good dividend paying stock. Maybe that's one you've held for like 10 years and you have a lot of stock in it. It's like 5% payout. I don't know, but you made $5,000 and it's a qualified dividend. Then that initial $30,000 is still taxed like a normal income at up through the 12% bracket, and then all of your $5,000 do not have any tax on them because you're still total of 35,000, which is underneath that 38,600 range, which would be the same thing as our other scenario here, where it was a capital gain that you held for more than 1 year. So do you kind of see how that relates? They're exactly the same. It's just the only difference is you hold the stock for 60 days to be a qualified dividend versus hold the stock for a year to make it a long-term gain. So again, we can do the same example with the 30,000. Somebody again also made $10,000 instead. Same exact scenario as we had here. So your total is 40,000. The stock, the non-stock or general income, shorter term income, all at the 12% range. And then you split up your 10,000 for the 8,600 that remains in this first bracket, is 30,000 plus 8,600 gives you that total to clear this out. So nothing taxed for this amount, and then you move up to the 15% for the 1,400, and that gives you only $195 out of that 10,000 that gets taxed in this situation. And if we do the 50,000 scenario again, it works exactly the same as we did in the capital gains thing. So that's kind of the trend we're going to follow all the way through this. I hope that at this point you guys kind of understand. We get that 50,000 starting off like a normal income, work your way through the brackets, so you get a total of 4,453 plus the remainder of 50,000 minus 38,700. That's taxed at 22%. And now since we're at 50,000, then the next 5,000 that we have from the dividends goes into the 15% range because we're starting that 5,000 within this range, so it's all at the 15%. And then again, 400,000, that's taxed as if you were making your way up through until you hit the 35% bracket, and that means you're starting at 400,000 in here. So the beginning part of that is 25,800 because that's how much is left in this range before you break through it. That gets taxed at 15. And then what's ever left out of your gain is taxed at that 20% because it is a limitless bracket. So anything above it gets taxed at 20%. And same thing here, you start out at 550,000 from your normal income. You have $50,000 in dividends that are qualified. So you have 37% bracket work through, which means you max out each of these. You start off with 150,000 again, and then apply the rest of your 50,000 from normal income at 37%. But your entire dividend is just starting off at 20% since you already started off higher than 425,000. So that's pretty much how the basic setup of your capital gains from stocks and dividends will all kind of get taxed when it gets mixed in with your normal income. I'm sorry about that mix up earlier about that 8,700. I guess I fat fingered a six. No, that's not possible. It's on the other side of the keyboard. I just messed up and looked over here for a second. I apologize for that, but hopefully you guys were able to figure it out even after my blunder. So I hope again that you guys found this somewhat useful. If you would like me to try to do a more in-depth one about special cases like Blackstone or foreign stock, please comment below and I will try to prepare something for that. Hopefully you guys found these examples and formulas useful. Again, if you like this video, give it a thumbs up or comments. If you think that there's some stuff I could still work on or improve, you didn't like the video, please let me know and I'll do my best to improve it for next time. So thanks a lot, guys. I hope to see you next time.